House Speaker Kevin McCarthy has sent a resolution regarding ESG to President Biden's desk. The resolution opposes a Labor Department rule which would allow retirement plan managers to consider ESG factors when investing. ESG stands for environmental, social, and governance. McCarthy argues the rule would mean lower returns for retirement plans. And earlier I spoke with distinguished NYU professor Aswath Damodaran on ESG. Damodaran has written several widely used academic texts in the business world. Joining me now is Aswath Damodaran. He's the professor of finance at NYU Stern School of Business. Now, let's start from the basics, Professor. In your view, what does a ESG score actually measure?
You're asking the wrong person because I'm not the person measuring it. And if you ask them, I think you're going to cut to the core of the problem. They're not sure. They're not sure in the sense that if you check across different services, they all seem to be measuring different things. And if you look across time, they at different points in time claim to have measured different things. I mean, if you go back in history and you look at the original UN document that gave rise to ESG, in the immediate aftermath, the people pushing and measuring ESG claimed it measured goodness, virtue. Now, how well you were behaving. Somewhere along the way, that sales pitch changed and it became ESG was pushed as something that would make companies more valuable. You could earn as an investor, you could earn more than the market. Then about 3 years ago, when that pitch stopped working, they said ESG is really a measure of risk. It's really nothing to do with virtue. It's nothing to do with goodness. And part of the reason is as each pitch failed, they kept shifting the goalpost. And now that ESG is not a very good measure of risk, because you look at the companies that get into scandals and catastrophes, it often seems to be that ESG is late to the party in finding those companies. They now claim it's just a disclosure device. It's for material. That's a key word. That it's really something that measures your exposure to material risks in the future. I'll be quite honest. I think that reflects part of the problem here is ESG is built on quicksand. The services and advocates of ESG have no idea what they're measuring, and they keep changing their mind. And they want you to spend hundreds of billions of dollars on a concept that they can't nail down. It's not my job to nail a concept down if you're selling it, but they don't seem to have an idea what they're selling.
And let's talk a little bit about those two aspects, good and risk. We'll start with good. Now, ESG, which part of that measures good? The S part, I suppose? And I know you have a view on that because
even
when we're talking...
Right? The E part is basically climate change. And somewhere along the way, it's virtuous to be in favor of decarbonization. It's sinful to push against it. So early on, ESG was very heavily tilted away from fossil fuel companies. They were viewed as evil. Tobacco companies, evil. So that's what I meant about it. Its roots are in virtue, but the E part of it was supposed to measure how virtuous you were about saving the earth. The S part has always been fuzzy because how does one come up with a definition of virtue that everybody can agree on? I mean, we live in a world where every issue, every social issue is split 50-50 down the middle. I mean, I challenge ESG advocates to name one social issue on which there's consensus, and you cannot. So the S part has always been in the eye of the beholder. So at different points in ESG's history, they've been willing to anoint something as good on a social purpose, but 6 months or a year later, they've got to retract. And if you look at the pushback against ESG, it's precisely because of that S factor. The S factor has gotten ESG into trouble because if you pick something where there's a 50-50 divide and you claim that 150% side is right, the other 50% is going to be pretty pissed off. And I think what you're seeing with the red states pushing back against ESG is the S part blowing up in ESG's faces. And so when ESG advocates complain about the fact that it's becoming political, my response is, you're like a pyromaniac who keeps complaining about how many fires there are around you. You brought this to the game. You brought the politics in with the S. The G part, I'll be quite honest, ESG people have no idea what the G in the G part is. I mean, the governance part in finance is about shareholders holding managers accountable. It has a long history. The G in ESG has nothing to do with shareholders. In fact, it explicitly is about all stakeholders in a company, which means it's got really nothing to do with traditional governance. Saying, why did they even bring it in? They brought it in because the strongest research in favor of ESG working is on the G part in traditional finance. So they've essentially adopted a word which they know, which comes with a pedigree of returns, and they've taken. I mean, the analogy I would give is I tell people the days before Germany was reunified, there used to be an East Germany and a West Germany. East Germany was under the Soviet wing, and I ask people, do you know what East Germany called itself? East Germany called itself the German Democratic Republic. There was nothing democratic. It was definitely not a republic, but they used the words because it gave them that patina of, hey, look, we're a free country. ESG adopted governance because it gives them this patina of respectability. But it's really a patina. It's really not deep.
And some of the proponents of ESG argue that it might better off your company or something along those lines. Let me ask you, what are your views on a company that scores better on ESG and giving it a higher valuation?
I can't give a company a higher valuation. It's got to earn it, right? Value doesn't come from what I think about the company. It comes from the company's capacity to generate cash flows, to grow those cash flows, and its risk. And this is the show me part of ESG. So I remember Larry Fink at the peak of ESG's glory getting up there and saying, ESG is good for value. And my reaction is, you're either lying, Larry, or you have no idea what value is. Because if you believe that ESG is good for value, show me where. Is it in the cash flows? Is it in the growth? Is it in the risk? And collectively, if you look at the evidence in ESG, there's absolutely no evidence that indicates that ESG shows off in any of those numbers. And if it doesn't, it's not affecting value. So you can tell me as much as you want that you think ESG is good for value, but until you show me, I'm not convinced. Could ESG help some companies? Yes, as a marketing tool, right? So if you're Patagonia, the fact that you are a good company might lead some people to pick a Patagonia jacket over, I don't know, an LL Bean jacket. Good for you. But if that's the case, why do you need ESG? You basically are doing this because it's good business, it increases your revenues, go for it. But don't lecture the rest of the world on how good you are and how they should do what you do. So ESG's value connection is so incredibly weak that I think, if you've noticed, they've stopped talking about the connection because they know that they don't have a case to make.
And I think that's some of the arguments on the Republican side, that ESG doesn't really generate profit. So what are the benefits of scoring higher on an ESG scale?
See, that's not even my problem. This is not about ESG not generating profit. It's about the fact that you're spending money on something, claiming to accomplish a social objective, and you have nothing to show for it. I'll be quite honest. I think that the problem with the anti-ESG movement is the fact that you shouldn't give this substanceless, empty concept any more space and room than it deserves. By making it the focus of your exercise, you're giving it far too much attention. It's really a concept it's a marketing tool. It's made a lot of people wealthy, bankers, consultants, measurement services. It does nothing for companies other than let them strut their goodness credentials. So I think the pushback is not that it doesn't increase profits. The ESG pushback is actually in the investing side, not on the value side. Their argument is by pushing investors to invest in ESG funds, you're essentially delivering lower returns. And if you have a fiduciary responsibility as a pension fund, as an endowment fund, you shouldn't be doing it. That's really the core of the red state argument. And I think they're right. A constrained optimal, where you take companies out of the mix because they're bad companies, can only deliver a worse outcome than looking at the entire universe. I'm saying, look at the entire universe. If you think oil and gas companies are overpriced, don't buy them. But don't buy them because they're overpriced. Don't reject them because they're bad companies, because that is a constraint that cannot pay off as higher returns. Here's the problem. ESG was sold on a false promise. It was sold as, hey, you can be good and you can make money. That's at the core of its weakness. It was sold on a lie. If you want to be good, you got to sacrifice something. I mean, remember, there were funds pre-ESG. The Anno Domini fund used to be a Catholic fund, which basically invested based on Catholic principles. And you know what? Good for them. But they were honest. They told people, look, if you want to invest, you're a Catholic, you want to invest based on Catholic principles. We're here. But they were open about the fact that by restricting themselves to only companies that met their criteria, they were going to have to give up returns. That's an honest pitch. And the way they sold it was, you're going to earn lower returns in this universe, but you'll get heaven afterwards. That's a promise I can go with. And the problem with ESG is not that there are ESG funds. I don't have a problem with ESG funds themselves. I have a problem with the fact that it was, at least for a period, it's no longer, I think, as strongly pushed. It was pushed on people who had no choice. People were made to invest in ESG funds and they had no control of the process. That's not right. That's the part that Vivek Ramaswamy, I think, makes very well, is he says, look, there's nothing wrong with starting an ESG fund, making the world a greener place, and trying to save the world from climate change. That's okay. But be open about it. Let people self-select into the fund, but don't force pensioners in Florida to invest in a fund that they had absolutely no role in creating while promising that you can deliver higher returns. You have a fiduciary responsibility you're violating. So the red state argument is not on the value front. It's really on the investing front and how investors are basically earning lower returns while being forced to invest in funds that have an ESG credential. So I think that rather than ban investors from investing in ESG funds, which is imposing a different constraint, that's the same problem, I would say let sunshine. Let people see, disclose what these ESG funds actually deliver in returns. Let people self-select and say, I'm okay earning 50 basis points lower on an ESG fund. I don't have a problem with that.
And there's something else I would like you to talk about, Tesla and ExxonMobil. You talked a lot about this in your various talks. So what does that show when Tesla has a lower ESG score than those other companies?
It just shows you the fuzziness of the concept, right? I mean, and I'll give you a couple of other examples. FTX, Sam Bankman-Fried's company, had a high ESG score before it crashed and burned. In fact, one of the features you notice in almost every company that goes into a crisis, they actually look good on a virtue basis. And that leads me to believe that companies have recognized that adopting the ESG cloak is actually a great way to hide scams and scandals. Why? Because if you claim to be doing this for the betterment of the world, Sam Bankman-Fried, what did he say? Effective altruism. People are afraid to push back because it sounds like you're an evil person to push back against something good for humanity. So I have no problem with ExxonMobil being ranked higher than Tesla. But then don't talk about this being about decarbonization. And I mean, let's face it, Elon Musk has done more for climate change than all of the ESG advocates put together, because he's changed the automobile business and made electric cars the center of the universe. So if you want to make him the bad guy, go ahead. But you're on very weak ground here because you're undercutting what you claim the entire game was. The original UN document was actually about climate change. So don't run away from it and tell me now this is different, you're measuring risk. You can't even make up your mind on what you're measuring. So why should I believe you?
And you also talk about it's sort of who can game this ranking better, right? It's not about what the companies actually do. It's about playing the game.
Anytime you have a score, you're going to game it, right? I mean, I'll give you a personal example. I work at a university, at a business school. And starting 40 years ago, business schools started getting ranked. Business Week ranked them for the first time. So every business school is on a ranking. And over time, we've learned what drives the ranking. And we as business schools have learned to play the game. So for instance, one of the things that goes into ranking is the percentage of applicants you let into the school. So you know what you want to do. You want to keep that as low a number as possible because it improves your ranking. The way you game the system is you make the application cost as low as possible because you want as many people applying so you can reject 95% of them. It's a stupid game. It's a costly game, but we've learned to play the game. Anytime you have a scoring mechanism, companies are going to game it. It's not because they're evil or bad. It's the nature of gaming. So when people complain about greenwashing and ESG advocates say, if only there weren't greenwashing, my response is greenwashing is a feature of ESG, not a bug in the system. It's there because you have ESG. Because the minute you have ESG scores, you are going to get greenwashing. And the more complex you make those scores, the more greenwashing there is going to be. This problem is not going to go away. It's only going to get worse.
And what do you think the impact will be, ESG, on society?
None. In fact, it's going to be to make society worse off. Because you know what we're going to do? We're going to talk about the problem. We're going to have hundreds of pages of disclosure. We're going to push the problem behind the curtain. And guess what? The problem's still there. In fact, it's going to be worse. You know how much of our energy came from fossil fuels in 2012 before ESG took off? About 82%. You know what percentage of our energy came from fossil fuels in 2022 after 10 years of ESG wins? 82%. So where's the win? What's happening? Why isn't it going down? Because what we've done is we've taken fossil fuel production and pushed it in the hands of private equity investors. That's exactly what's going to happen when you put selective pressure on publicly traded companies and make them give up on things that you claim are bad. They don't go away. This is moved into different hands, and you're going to have no control in how they're developed. So my view is ESG is going to make society worse off. It's going to make some people richer, but society overall is not going to be one of the beneficiaries, because it's going to mean we're not going to act on our problems because we're assuming that they're being dealt with already.
So in your view, ESG is here to stay. It won't ever disappear?
Well, I think it'll get renamed. The nature of these things is at some point in time, the acronym starts to not make money. So you know what? You rename it. You call it sustainability. You call it something else, some other fuzzy word. You put up. So this is something, ESG is not the first time we've had a game like this. You know, it's acronyms come, acronyms go, and they get renamed. So something like ESG is always going to be here because you have hucksters out there who want to make money. I mean, let's face it, Harvard Business School exists to create buzzwords for McKinsey to go out and sell to their clients, who then get to put these into investment funds and market it to us like crazy. This is not the last buzzword. There'll be other buzzwords, all equally as empty, or all equally just as damaging.
Yeah. Thank you very much today,
You're
Professor. Welcome. It was such a pleasure speaking to you. Appreciate the conversation.
Thank you.